the morning. It reported a muted set of earnings this time around in Q3. So, let's get straight to the management and find out what the way forward looks like in terms of the numbers. Debashish Chatterjee, the MD and CEO of the company, joins in. Mr. Chatterjee, thanks a lot for joining in. Can you tell us what changed for you in this quarter? This quarter has been lower than, street estimates, and there's been a lot of pressure. Your margins have contracted as well. But what went so wrong?
As far as this quarter is concerned, we always knew that there will be, it's a seasonal quarter in terms of furloughs. And if I look at what really happened in the quarter, the furloughs are much more wider and deeper. What I mean by that is the furloughs used to be pretty much restricted to a couple of industries. But this time we saw not only did the furloughs go deeper into those industries, much more significant, but also the industries in which we never saw furloughs, we experienced furloughs in those. So that was a surprise element for us. And the other thing also which continues is the delayed decision making. There are quite a few. If you look at our overall order book, we are still doing pretty well in terms of deal inflow. It's actually a record. It's at a record high. But there are still quite a few deals which are at the final stages, and the decision making is significantly delayed. So these are some of the things that played out, and that is why we feel that it's better to reset the expectations at this point of time rather than going forward.
All right, that point is taken now, Mr. Chatterjee. But you said that we've seen furloughs in Q3 in sectors where we have not seen furloughs typically. Which sectors are you referring to?
Well, furlough is pretty much an impact of, or it's basically depending on your portfolio of clients that you manage within the industry. So this is nothing like, when you talk about a specific industry, every client goes through a furlough. It's not like that. But this time it was much more broad-based. So it's very difficult to, you can probably say that across all the industries, even industries like oil and gas, where energy and utility, where we never had furloughs, we saw furloughs over there. Now, as far as the recovery is concerned, we anticipate the recovery will be gradual. So the furloughs will come back, but it will gradually come back. And that's why we said that, our Q4 will be similar to Q3.
All right, you've pushed forward your aspirations of hitting that 17 to 18% EBIT margin in Q4 by a few quarters, you said. Tell us why and what is the expectation now?
Well, I think rather than talking about FY 25-26, let me tell you what exactly we have been doing. Margin is not something which is, you can't just do it on one particular quarter. It's a program that you run, and as per, it's a disciplined execution, and that gives you the confidence that you will be at a certain level at a certain point of time. And that's what we have been saying, but it also depends on how the revenue is going to kick in. So essentially looking at all the factors that we have, the macro, the way the Q3 has gone, it is important. And if you look at utilization, our utilization is all-time high. So we need to have the ability to reinvest back into the business as well as we, as a lot of deals have closed, more deals are going to close. So keeping all these things in mind, we felt that our overall margin plan is not going to change. That means the disciplined execution is not going to change. But we just want to ensure that we are not pushing the margin agenda so much that we don't capture the growth opportunities as and when they appear, as and when they emerge. So that's what we are doing. And that's why I said at least a few quarters we want to push out the 17 to 18% goal that we have. That goal still remains intact from a long-term perspective.
Okay, well, your order inflow of around $1.5 billion is at a record. So what percentage of that of these are cost takeout, and what percentage is discretionary?
This is not something which has changed. I think the last 2-3 quarters we have been saying that as a company we used to get a lot of projects, or we used to participate very heavily in discretionary spend. The discretionary spend has almost evaporated, and the deals that we are seeing right now are mostly in the cost takeout and efficiency deals, and that continues. So majority of the order book that you see right now is cost takeout and efficiency, which requires, first of all, it takes a little longer time to close those deals. And even if after they close, there is a transition involved in many of the situations. So the ramp up also takes a little bit of time. So keeping all these things in mind, we are still confident that over a period of time, once all these deals kind of start ramping up, we will see again, see a decent growth, but it will take some time.
So manufacturing has clocked in a smart growth this quarter. What is driving that, according to you?
Well, the manufacturing is, there's if you look at the seasonality again, there is a pass through that kind of comes in Q3. So essentially, what you see in manufacturing has also a component of pass through, which is not going to be there in the next quarter. So essentially, that's why manufacturing you see a slightly higher growth for this quarter.
Okay, now just coming to margins, what about your Q4 margins? While that 17 to 18% guidance has been pushed forward, will Q4 margins also be probably similar to Q3?
Yes, I mean, when I say Q4 will be similar to Q3, we will always try to better it. But at this point of time, it is good to assume that it will be very similar, both in revenue and margin.
How is the BFSI segment X of these furloughs? Do you see any signs of recovery at all?
See, BFSI is, we are definitely seeing some, a lot of caution in BFSI, especially BFS. And as a result of which, if you see all the verticals that we have, all the verticals have still registered year-on-year growth for this quarter, except for BFSI, where we had a 1.4% decline year-on-year. Yeah, it is definitely attributed to the deeper furloughs that we had. We always knew there will be furloughs in Q3, but it was deeper. But otherwise, most of the other parts of the portfolio, I think it is we are not really too worried, because the kind of work that we do in BFSI, there's a lot of regulatory, a lot of emerging areas which will continue to come back as we go along.
All right, okay. When you announced your merger with Mindtree, you had spoken about revenue synergies of around 1 billion, cost synergies to drive around 200 basis points margin expansion to 19 to 20% by FY27. Are you maintaining that guidance?
I think if I have pushed back the overall margin program by by a few quarters, then I think it's appropriate to say that also will be getting pushed out. But overall plan is intact. I mean, I want to reiterate that when we made all those commitments, it's basically based on a very long-term planning that we have done, and we are very confident that we will achieve that. But at this point of time, it is important for us to acknowledge that given where the utilization is, which is what we have been pushing, and given the fact that we have closed so many deals, we have to reinvest back into the business, which is critical for us as we, as and when the market opens up, we want to capture the growth opportunities.
Okay, all right. So we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is LTI Mindtree under pressure. The guidance has been a little bit cautious as well. They have said that they've seen furloughs in quarters and in sectors where they've never seen it before, such as energy and utilities. And there was delayed decision making, which they encountered this quarter as well. But they are optimistic in terms of a recovery, especially in terms of margins going into Q4.